Most people think a missile strike changes the battlefield, but in the modern world, the real shockwave often lands somewhere else entirely. Not on a front line, but in an oil terminal, a shipping lane, a central bank meeting, or a mortgage contract thousands of miles away. A missile launches in one region, oil traders react in another, bond markets tremble in New York, and suddenly borrowing money to buy a house becomes more expensive in cities that have never heard the sirens. It sounds improbable. Yet this chain reaction has happened repeatedly over the last half-century. The global economy is built on systems so tightly connected that a military escalation can quietly reshape interest rates, currency values, and household budgets across continents. So how exactly does a missile strike somewhere in the world end up affecting something as ordinary as mortgage rates? To understand that domino effect, we have to start where geopolitics and economics meet. Energy. Modern economies run on oil and natural gas. Transportation, manufacturing, agriculture, and global shipping all depend on it. Because of that dependency, even the risk of disruption in energy supply can move markets before a single barrel stops flowing. When tensions escalate in regions that produce or transport oil, traders begin pricing in uncertainty. That uncertainty shows up first in oil futures markets, where contracts for future deliveries are bought and sold every second. If investors believe supply might tighten, prices climb immediately. History offers several clear examples. During the 1973 oil crisis, Middle Eastern producers cut exports during geopolitical tensions, and oil prices quadrupled within months. The shock rippled across global economies, triggering inflation and forcing central banks to rethink monetary policy. More recently, disruptions during the Russia-Ukraine war sent energy prices surging across Europe and beyond. But oil prices alone don't determine mortgage rates. The real link lies in inflation. Inflation simply means prices rising across the economy. Energy is one of the fastest ways inflation spreads because fuel affects nearly every supply chain. If oil becomes more expensive, transportation costs rise. Shipping containers cost more. Fertilizer prices increase. Food becomes more expensive. Airlines raise ticket prices. Factories pay more to operate. Gradually, those higher costs appear in the prices consumers see every day. And when inflation accelerates, central banks step in. Institutions like the Federal Reserve or the European Central Bank raise interest rates to slow spending and cool price increases. Higher interest rates make borrowing more expensive. Credit cards cost more. Corporate loans become harder to service, and mortgages follow the same trend. This is where the geopolitical domino reaches ordinary households. A conflict that raises oil prices can trigger inflation. Inflation can push central banks to raise rates. And those higher rates directly influence mortgage payments for millions of families. But the chain doesn't stop there. Financial markets add another layer of complexity. When geopolitical tensions rise, investors seek safety. They often move money into assets perceived as stable, such as government bonds or gold. This behavior is known as a flight to safety. Capital leaves riskier markets and flows towards stability. These capital flows can strengthen some currencies while weakening others. Currency shifts then influence trade balances and import prices. A weaker currency means a country must pay more for imported goods, including energy. That adds further inflation pressure, which brings central banks back into the picture again. The cycle continues. To see the full structure, it helps to widen the lens beyond a single event. Global energy markets depend on a handful of critical routes, known as strategic choke points. A choke point is simply a narrow passage where large volumes of trade must pass through. One of the most important is the Strait of Hormuz. Roughly a fifth of the world's oil shipments travel through this narrow waterway between the Persian Gulf and the open ocean. If tensions threaten shipping there, oil markets react instantly. Another key corridor is the Suez Canal, a vital shortcut connecting Europe and Asia. Blockages or security risks force ships to reroute around Africa, adding weeks to delivery times and raising costs. These routes reveal why even localized conflicts can become global economic events. Energy, shipping, and finance are interconnected systems. Pressure in one part quickly spreads to the others, but the deeper forces driving these reactions are structural. Many economies remain heavily dependent on imported energy. When supply becomes uncertain, governments face a difficult balancing act. They must protect domestic economic stability while responding to geopolitical pressure. Sanctions illustrate this dilemma. Sanctions are economic restrictions placed on a country to influence its behavior without direct military action. They can limit trade, freeze financial assets, or block access to international banking systems. The goal is to apply economic pressure rather than military force. But sanctions often reshape global markets in unintended ways. When large producers face sanctions, global supply can tighten. Other countries may step in to fill the gap, sometimes gaining economic leverage in the process. Meanwhile, energy prices fluctuate, influencing inflation worldwide. Debt adds another layer of fragility. Governments, corporations, and households have accumulated significant borrowing over the past decades. When interest rates rise to fight inflation, servicing that debt becomes more expensive. For homeowners, that often means higher mortgage rates. For governments, it means larger portions of national budgets going toward interest payments instead of infrastructure or social programs. For businesses, borrowing for expansion becomes riskier. This is why financial markets closely watch geopolitical signals. Not every missile strike leads to an economic shock, but markets constantly assess whether an event could disrupt energy supply, trade routes, or investor confidence. Confidence, in financial terms, is often as important as physical supply. If investors believe a situation could escalate, they react early. Prices move before the real-world consequences fully appear. Gold markets reflect this behavior clearly. Gold has long been viewed as a store of value during uncertainty. When geopolitical tensions rise, demand for gold often increases as investors hedge against instability. The same pattern appears in government bond markets. Large inflows into bonds can push yields lower temporarily, but if inflation fears dominate, yields may rise instead. These competing forces influence long-term interest rates, and long-term rates are a key benchmark for mortgage pricing in many countries. In other words, the cost of a home loan may ultimately depend on how investors interpret global risk. Consider the broader pattern. Energy supply disruptions influence oil prices. Oil prices influence inflation. Inflation influences central bank policy. Central bank policy influences interest rates. Interest rates influence mortgages, business investment, and economic growth. Each step appears separate, but they are tightly linked. This interconnected structure is one of the defining features of the modern global economy. Military power, financial markets, and energy supply are no longer isolated domains. They operate inside a single system of incentives and reactions. Strategic decisions by governments therefore ripple far beyond their immediate objectives. A missile may target a military facility, but the economic reverberations can reach oil markets, currency exchanges, and household finances within hours. That reality explains why policymakers often weigh economic consequences alongside military ones. Escalation carries financial costs that extend well beyond the battlefield, and markets are quick to calculate those costs. In the end, the domino effect from missiles to mortgage rates isn't mysterious. It's the predictable result of a world where energy, finance, and geopolitics are deeply interconnected. Understanding those connections helps explain why seemingly distant events can shape everyday economic decisions. If this helped you see the bigger picture, take a moment to like the video, share your thoughts in the comments, and subscribe to Rise and Ruin. Power of Wealth for more documentaries on oil, power, and the forces shaping global finance. Because in the modern world, the most powerful forces are rarely the ones we see first, but the systems quietly moving everything behind the scenes.